What if I told you Canada's housing market isn't heading for a correction? Because in some cities, it's already here. Toronto just posted its worst March sales since 1998. Vancouver listings are surging, prices are slipping, and confidence in the real estate market is still shaky. But at the same time, Edmonton is heating up, interest rate cuts are around the corner, and in the long term, we're building fewer homes than we've had in 40 years. So what's actually going on here? In this video, we're breaking down why Canada's market is pulling in two different directions at once. What's driving this shift in each major city, and what does this all mean if you're buying, selling, or investing this spring? Because the next few months could reshape everything. Real quick, if we haven't met, my name is Richard. I'm a Canadian real estate agent, and I break down what's really happening in the housing market with data, insight, and no hype. You can go to some other channel if you want that. This channel is all about making Canadian real estate easier to understand, whether you're buying, selling, or just trying to make sense of it all. So if that sounds helpful, hit the like and subscribe button so you don't miss out on future videos. Before we get into the specifics of each major market in Canada, let's just zoom out first and talk about the major trends that are happening. In March, Canada has lost 33,000 jobs, the steepest monthly decline in over 3 years. Ontario accounted for the bulk of those losses, especially in the GTA. Full-time jobs dropped by 62,000, and the private sector employment fell by 48,000 jobs. Signs that the slowdown is starting to hit both households and businesses. Unemployment rose to 6.7% nationally, but in Toronto, it's at 8.8%, a full 3 percentage points above the lows we saw in 2022. And the big concern that I see is the long-term unemployment is rising fast. That's the clearest signal for mortgage risk because it's not just about losing work, it's about being out of work for months. But on the rate front, the Bank of Canada did not cut rates in April, which was kind of a surprise. But most forecasts still expect first rates to happen between June or July. We're not sure yet. Markets are betting on the overnight rate falling to 2% by summer, which would bring mortgage rates in the low 3s or even high 2s, potentially unlocking demand that's been sidelined for over a year now. And while inflation has been a constant concern, affordability is improving in a big way. Mortgage payments could drop up to 30% from their late 2023 peak by summer if the rate cuts fall as expected. And so for quick math, that's like slicing $800 to $1,200 a month off of your mortgage. Wage growth is running near 25-year highs, which is helping households manage costs even before these expected rate cuts. Household savings are also near a 30-year high, which means there's capital waiting on the sidelines, ready to move when confidence returns. 3 things to really keep in mind here. First, being pent-up demand is a real thing right now. Even though sales are soft right now, much of that is due to the temporary hesitation, not the lack of interest. Immigration data shows permanent residents, future homeowners, are still arriving in large numbers, while temporary residents, which are mostly renters, are slowing. So demand isn't gone, it's just delayed. Second being that Canada's long-term housing supply problem hasn't gone away. Permits for single-family homes are at their lowest level in 40 years, especially in Ontario and BC. And that's a potential problem for future inventory issues once demand rebounds. Even today, we're seeing less than 5 months of inventory available nationwide, still below the historical average of closer to 6 months from 2010 to 2020. That tells us this is not a true oversupply environment, just a temporary sluggish one. And the third thing is tariffs and currency pressures may limit how far the Bank of Canada can go. While rate cuts look likely for the summer, the second half of the year could bring inflation risks back into the picture. A weaker loonie and rising import costs could force the Bank of Canada to slow or even pause the rate cuts that everyone's expecting here. This mix of just short-term softness and long-term pressures is what's going to make 2025 such a pivotal year for Canadian real estate. But enough with the broader economics, let's just look into what's happening in each major city across Canada, starting with Vancouver, which saw a small rebound in March. Sales were up 1% month over month, but overall activity is still soft, down 13.4% year over year. That makes this the second slowest March for sales in over 2 decades. The bigger story is inventory. New listings jumped 29% year over year, one of the sharpest increases in recent memory. Active listings rose 38%, pushing total inventory to the highest level for March since 2014. The sales to new listings ratio dropped to 33%, a level we just haven't seen in over 25 years. That indicates a very slow absorption rate, with many homes sitting on the market longer, which has all translated in the total months of inventory hitting 7 for the month of March, which is just slightly lower than the 2019 levels. Prices are also now responding to this shift. The MLS HPI slipped 0.3% in March, the third consecutive month of decline, a sign that the market is trending downwards. Construction activity is also slowing. Total housing starts are down 1.2% month over month, and there are just 3,100 single-family homes under construction across Metro Vancouver right now, which is the lowest figure since 2009. So as a recap, we got a market that's softening, sales are still weak, inventory is building, and prices are starting to slide. But now let's jump across the country to Toronto, where the story isn't just similar, it's more extreme. And stick around because right after Toronto, we're heading west to Edmonton and Calgary, where things are moving a completely different direction. Toronto is now firmly in correction territory. Sales fell 2.4% in March, following a massive 28.5% drop in February, which translates into the worst March for sales since 1998. New listings, however, are flooding in, with them jumping 32% year over year. Active listings rose 89%, now at their highest level since 2009. And in the 416 area, detached home listings are up 160%. Condo listings hit a record for March as well. Then to top it all off, the months of inventory, another measure of supply and demand, rose to 4.8 overall. And it's the highest in at least 2 decades in the condo segment specifically. And with that imbalance, it pushed the sales to new listings ratio to just 29%, the lowest since 1991. Prices seem to be following this trend as well. The MLS HPI fell 1.4% in March, on top of a 1.5% in February. Condo prices are down 4.8% year over year. And there's a bigger story that's happening in the condo market right now. Construction activity is slowing. New condo sales are down 95%, with fewer than 4,000 units sold in the past year. And if this continues, we could see a dramatic shortfall in completions post-2028, which sets the stage for a long-term undersupply. The numbers still don't pencil perfectly for condo investors, but we're seeing the best return profile since 2022 thanks to these slower prices, just resilient rates, and steady principal paydown. I'm not saying you should jump into the market right now and invest, but early signs are emerging. So while today's conditions look a little soft, the long game still points to opportunity. Now let's head over to Alberta, as this is where the story gets interesting. Both cities saw small sale declines, but their underlying momentum is totally different. Edmonton sales are still up year over year, and the market remains hot with the sales to new listings ratio in the mid-70s. And inventory is down 8% near decade lows. And then when we look at Calgary, sales are down nearly 20% year over year. Listings are up 27%, and inventory has more than doubled compared to a year ago. And when we look at all that data, the current prices reflect the trends that are taking place in either city, where we have Calgary, which has just posted its first price drop since 2022. And when comparing price growth between Edmonton and Calgary, Edmonton is now 11% ahead over the past year, which is the largest performance gap since 2007. And when we look at the sales to new listings ratio, the contrast is just as clear. Edmonton is sitting around 75%, which signals strong demand, and Calgary has dropped to about 58%, the lowest since 2019. And now let's talk about construction between the two cities. In Calgary, construction is being led by purpose-built rentals. In Edmonton, construction is still measured and responsive to demand, which is why prices are holding firm. The takeaway is that these are two completely different markets, and local knowledge matters more now than ever. So now that we've broken down what's happening in Vancouver, Toronto, Calgary, and Edmonton, let's talk about what this actually means for you. Whether you're looking at buying or just thinking about selling, or just trying to figure out if this real estate market still makes sense as an investment, this next part is where it all comes together. Because in 2025, the best opportunities won't be nationwide. They're going to be hyper-local. And the more you understand your market's position, the better you'll be able to move with confidence. If you're a buyer, I'm going to start with you first. In Toronto and Calgary, you have leverage. With more listings and fewer active buyers, now's the time to negotiate. Whether that's the price, terms, or just the conditions of the contract. Don't rush, but don't sleep on great homes either. If you're in Vancouver, keep an eye on the market through late spring. If inventory continues to climb and prices keep dipping, you'll have better negotiating power going forward. Though if interest rates drop more, that will likely change. Then if you're thinking about buying in Edmonton, this is still a fast-moving market. Detached homes under $500K are especially competitive, and inventory is tight. So just be prepared. get pre-approved, and act quickly when you see the right fit. Now, if you are a seller, this next part is for you. In Toronto and Calgary, pricing matters a lot. Overpricing by even 2 to 3% can push your listing into weeks or months on the market. So what I always say is stage well, understand your competition, and lean into strong marketing to stand out in these crowded conditions. Now, if you're in Edmonton, you are in a stronger position, but today's buyers are savvy and rate conscious. If you're priced right and move-in ready, you'll likely attract serious interest. But don't take the demand for granted because that can easily change. Now, if you're an investor, this next section's for you. Edmonton is leading the country for cash flow potential right now, with resilient rents, price growth, and just measured construction all working in your favor. If you're looking for a lower risk income generation property, this is worth a serious look. Toronto condos are still cash flow negative in most cases, but the return profile is improving. For long-term investors willing to hold out through 2026 to 2028, this may be an ideal time to position for future growth. And then Calgary is shifting into a longer hold environment where short-term upside is limited, but steady population growth and a diversifying economy still supports the fundamentals for patient investors. And as we can see here, Canada's housing market isn't following just one simple storyline in 2025. Some cities are clearly correcting. Others like Edmonton are gaining real momentum. And the interest rate environment could flip the script entirely by midsummer. So if you're trying to make a smart move this year, don't just watch the headlines, watch your local markets, because that's where the real story is. If you found this update helpful, give it a like and subscribe so you don't miss out on next month's report. And if you want to see how this compares to last month's report, where I break down trends that are still shaping the market today, I'm going to link that video right here. And while you watch that, I'm going to go fly some drones.